So good afternoon, good morning and welcome to a Capco hosted webinar. I'm delighted to be joined by a number of panel members today, which I'll introduce in a moment. But firstly, let me just introduce myself. My name is Owen Jelf. I have the pleasure of being the global head of the capital markets business at Capco. And in the context of that, obviously part of my job is to understand and ensure that we are relevant to our clients in this space and understand the key themes and key issues. So we have developed some thinking that aims to summarize and also at the same time detail some of the challenges that global markets firms may be presented with in the industry. And I'm delighted that we have the opportunity to discuss some of those themes today and get a perspective from some leading institutions and clients that are operating in that space and dealing with these things day in, day out. So if I could just move to the introduction of the panel. So I will host and moderate. I'm delighted to be joined by Susie White, who is the Global Markets Chief Operating Officer at HSBC. She's been at HSBC a number of years, and I actually first met Susie in the US when she was the America's COO for the investment bank of HSBC. Delighted also to be joined by Max Saboto. Max is also the COO for the global markets business, but this time at UBS. Max has been at UBS for over 10 years. Prior to that was at JP Morgan, and clearly also, like Susie, have a very good perspective on the issues that the organisation faces currently. And then we have two representatives from Capco that are joining on the panel. Firstly, George Black. George is the US lead for the capital markets business at Capco. Been in Capco for a number of years. Prior to that was many years at Lehman Brothers and then latterly Barclays, obviously following the acquisition in 2008. And then Andreas Feil. Andreas operates as the European capital markets lead. Again, many years at Capco, and prior to that was many years at Accenture, and I think exclusively operating in the capital market space. So if we just turn to, I guess, our view of the themes. Clearly, global markets is a complex and very dynamic business involving billions of dollars of revenue, large costs, a very complex global ecosystem that needs constant management, and there's a constant, I guess, change agenda in the industry. Regulation is a constant theme, and then clearly cost has been a major theme, as well as the digitization and the introduction of new technologies. And I guess more latterly, geography and locations and where one would operate from. So it's very hard, I guess, to be completely succinct given the nature of the industry. But we've tried to distill I guess the problem set for 2021 down into 7 key themes. We're going to have a go today at debating these and understanding, I guess, how some of the institutions we have on the panel think about these issues and how they're presenting solutions, as well as our regional Capco leads about how they feel that the clients operating in the industry, say in the US or in Europe, are also worrying about these. So if I quickly touch on them, number one, I'm sure many people in the audience are wrestling with this day in, day out. There clearly is a very large legacy technology estate in many firms that has grown up over multiple years of sometimes very, very fast-paced growth, some of it through acquisition, and it presents a challenge about how you would optimize the cost base, frankly, front to back, when perhaps there is a similar solution across many asset classes, to name one challenge. Secondly, there's a constant push to grow revenue, grow market share, grow profitability. How is it best to achieve that? There are strategies around business growth, business exit, RWA optimization, geographic focus. There are many strategies that can be adopted, but ultimately that pressure is very much always there. Then number three, digital and capital markets has been a topic that I think actually predated the digital we see in the industry more widely, or industries more widely. The dematerialization of share trading, for example, and payments, the SWIFT network, and many of the innovations that we've seen in the capital markets, in effect, were digital. But I think there is now a renewed push to adopt various technologies, perhaps powered by the cloud, but there's also distributed ledger technology, intelligent automation, and the like, that can really make a difference to how an organization serves its customers, and can actually differentiate. And also then that can feed into some of these other issues, such as how you can use digital to grow one's market share and revenue. Item number 4, data, and making data really work for the enterprise. Again, I think our view is that is a constant challenge about how you can really get to a quality set of data, or quality data sets that can really inform your client base's behavior, really understand customer profitability, use it to generate trading ideas, for example. And similarly, inside the institution, can you use data effectively to spot potential compliance issues, potential fraud? Can you survey in the right way? So strategies around that are, I think, increasingly important, particularly with the push into digital and executing digitally. Number 5, the regulatory burden. It seems sometimes year on year that, in fact, the regulatory pressures only increase as opposed to reduce. And it's been some time now since the financial crisis and all the associated reg coming out of that. But we look at 2021, we have the IBOR transition, we have FRTB, we have Basel III on the credit side, we have CSDR, we have new reg coming through for resilience, we have reg that's emerging for crypto assets and so on, and then the resulting tidy up from MiFID and so on. So it still involves a significant spend at many global markets or banks in general. So how does one deal with that? How can you reduce costs whilst at the same time complying and using that investment perhaps to get to competitive advantage? And then number 6, I kind of like to think that maybe 10 or 15 years ago, the solution around location was it's never easy, but it could have been defined as metropolitan centers for your front office, Asia for your back office, in very crude terms. But I think now it's far, far more complicated than that. And there are multiple competing challenges around the introduction of digital technologies, perhaps reducing the need for larger back office teams. How do you deliver quickly? What does it mean now that remote working has, many people have different views on this, but broadly it's been a success. What does that mean then for a high cost metropolitan center real estate footprint? Does one need all the front office in the office, for example, then what does that mean? We've seen some things such as I think one institution setting up in Birmingham very recently in the UK as an example. So there are lots of factors here to think through. And then finally, cloud. I think absolutely cloud technology and the benefits of cloud technology in terms of ability to support burst compute capacity and security and cost reduction and so on. But where is it really at? And what is then the agenda in 2021 to push that? And how's that linked then to the legacy problems? So I guess those were our view as to where the challenges are and almost the agenda for a COO on a daily basis. So I guess I'll turn now, and I'll start with you, George, to I guess have the discussion around number 2, around revenue, and just give your perspective on how you think about it, and then obviously we can invite Susie and Max to share their perspective. So over to you, George.
Thank you very much, Owen. Thank you everybody on the panel for joining us today. Revenue is number 2 on our list there, but I think it's number 1 in what drives all of us every day in this business. All these other goals are about optimizing around that point, I think. The reason we want to talk about this at Capco in this thought piece and on this panel is just on the back of 2020, which due to COVID and due to the unprecedented volume and volatility that we saw in the market from the trading side, due to the unprecedented levels of debt issuance that occurred and the origination fees that went along with that. Every capital markets organization on the street has just had a record 2020 that far surpassed any goals coming into that year. And the question that I think is laid out to every single head of capital markets is, how do you continue that momentum if you can? And if not, what's your plan for setting a new baseline, maybe growing from a different position, stepping up from a different stair and charting your course forward? Because if we're going to be back to normal levels of volume, volatility, and origination, then obviously we'll have to make a plan to take market share, to grow your wallet with your client base and get back to basics, as it were. So 2021 has proven to be, strong first quarter though in capital markets. And so I think that many firms are doing a very good job in capturing the momentum coming through on 2020. And I think the goal is to continue to keep that rolling. When we work with our clients on a strategy project such as this, where we're trying to put a frame around, how do you grow revenue in your business? We tend to think of it from a structured point of view. We think of it from the perspective of, what does it look like inside your firm? What are your core assets? What are your core strengths? How do you lean into that? How do you prioritize what you do well? How do you open your leading services to new customers, maybe expanding your customer acquisition? How do you open up new capabilities to your existing customer base, to your leading customers that want to do more business with you? So those are all looking inside at what you can do better and how do you optimize the tools and client base that's available to you. We also talk about looking outside. We look at, what's an acquisition strategy that would allow you to gain access to a market that you want to be involved in? What's a, creation of a new business line strategy that would allow you to step into something that you previously hadn't been involved in? Or perhaps on the other end, maybe you need to divest a unit that's underperforming your cost of capital and you need to reallocate that capital to businesses that are more profitable. So we look inside, we look outside. And then in this day and age, as Owen mentioned, the prevalence of data assets, the prevalence of investments in digital, we believe our clients are creating new assets, starting with the customer in mind, right? If you start with the customer in mind, you can inform yourself about how best to build for their needs. So for instance, if you're building a very fancy platform that's going to be all singing, all dancing for your most demanding customers in one part of your bank, you have to think about what else they want to do with you and how that complements those businesses. It's really difficult to build, something that's world-class and capture the entire wallet of your customer. You have to build everything up to a certain level of snuff, and you have to understand what your customers need in order to do that. And then ultimately, you need to understand the value of your own data. Our clients, I would say, we're in the early innings, to use a baseball metaphor, of understanding the value of the data that exists within banks today. There's so much more of an asset that we think our customers, our clients, can tap into. Leveraging that data, as Owen mentioned, to drive trading ideas, to drive leads, to drive efficiency, to drive client experience, and all of the related topics that help grow the top line revenue ultimately, which is what we're talking about here. So that framework is generally how we think about it when we step into something with a brand new situation. We say, look inside, look outside, and look at what new assets can be created. With that framework in mind, or perhaps with a different angle on it, Susie, I'd like to ask if you have some thoughts about how your organization or what you've seen be successful in your career in engaging in those topics of revenue growth.
Great. Yeah, thank you. And look, I think this was a great piece, and it was a really interesting read. I think for us, I pick up on the focus and the focus on the strengths that you mentioned. And one of the big things that we've been doing over the last few years is to stop trying to be everything to everyone in every country that we operate, and really think about where are we at our best, where are our strengths, and really focus on growing those strengths and focused growth. And for us, obviously, there's a lot about Asia in that equation. The other big thing for us is not thinking about revenue and market tables and market lead without thinking about the overall returns, right? Really being focused on capital, liquidity, financial resources, optimizing the entire equation, looking at the cost base, so that we're not just going after revenue without a full understanding of what does that dollar of revenue really return for me in that particular market and client base. And one of the really important partnership roles that I have, and it's an exco position here, is our head of financial resource management. So we have a dedicated individual who isn't assigned to one asset class, who is responsible across the business with the rest of the exco for managing those financial resources. She will determine the capital, the liquidity, the resources we add as part of the strategy, and where we add them, and making sure that we think like that, and we're not just thinking about the revenue dollars, we're thinking about the overall return, think about all the factors in that equation, and we're thinking about very focused growth is sort of how we're framing that strategy at the moment.
No, I think that's compelling, Susie. I think that those are effective strategies. We've seen that obviously major global businesses being divested because they're not bringing the right return, and focusing then, in your case, HSBC, on growing your footprint in Asia, where you do have competitive advantage. I think really leaning into that competitive advantage is a key feature for sure. Max, I'd like to see if you have some thoughts on this as well. Is your organization similarly focused on profit, over revenue, or is the top line growth driving the agenda at all?
I think what we continue to see, I think, is a continued divergence of strategies and business model post financial crisis. And so I would say that there is a lot more emphasis into stay true to your strategy and your business model. I think that is evident in many firms today, and the degree of differentiation varies across U.S. and non-U.S. firms, as we know. The degree of risk and resources that firms deploy, quite frankly, also the level of integrations across different business units in banks. I think that's is becoming more and more a source of long-term strategic value for banks, and clearly the geographical focus as well, which I think in some shape or form many banks are actually after as well. For me, really is. Again, depending on your business model, there are certain things which are probably more imperative than others. For us, the continuous journey to deepen our relationship with clients and customers, and how you go through that journey from pricing, content management, execution, liquidity, scale, all the way to post-trade. That is and continues to be an absolutely key part of how we think about business. And as a result of that as well, clearly looking at technology, not necessarily as a way to only scale up and make the business more resilient, but also how do we make the business different through technology, which I think requires quite different way of thinking through not only the software, the hardware, but also to the point you made earlier, George, the how you harness the power of data, both internally and externally as well. And clearly, obviously, maintaining a balance sheet for all seasons clearly something that I think is also fairly common across the tier one players as well.
I mean, those are great points as well, Max. You know, I think your point about focusing technology not only for resilience but also for differentiation, that's really a fascinating strategic lens to apply. Because I mean, resilience, you know, up until the moment when you need it, it seems like, you know, you're spending money on things that maybe don't show you quite the same return, but in that moment when you need it. So for instance, in those, you know, those days of late March last year or April and into May, you know, many firms I know who'd invested quite a bit in their resilience were quite pleased with how their infrastructure held up at these levels of unprecedented trading volume. And, you know, again, you don't know when you're going to need it, but you know at some point you will. Let's talk for a little bit. Let's pivot slightly then and focus on investing for differentiation. I like that as a transition point, Max, because it really brings us into this whole notion and this loaded word of digital. You know, what does that mean exactly in capital markets? And in particular, I do believe that investing in data and data-related assets is a critical feature of the next several years of our business. You know, when we talk about digital, we're talking about, you know, people-related things like agile and DevOps and modern delivery. We're also talking about automation. We're talking about robotics. We're talking about machine learning and structured data that gets you decision-making, and AI and unstructured data that helps you understand, you know, what you're dealing with. It's also about cloud. It's about DLT. It's about digital currency, which is, I mean, I've seen more activity in the market around digital currency in the last 6 weeks than I anticipated. Frankly, you know, as somebody who's trying to stay on top of that curve, it's a challenge, obviously, to stay informed about what's going on there. But digital currency is a real thing that every bank is thinking about as well. So with that lens, you know, one of the pieces of our core thesis here is that digital is it's a continued journey in capital markets. The levels of automation that went on, even, you know, Owen mentioned, you know, some of my background prior to Capco, working at large bulge bracket banks, global universal banks. You know, we were investing in automation in 2001, 2002, 2003, absolutely. And that's not old. And the need for, I'm sorry, that's not new, but the need to take out cost is still there, right? So I think that there's further up that chain that the automation can be pushed within the capital market side of the industry, both in the front office and in the back. But the much more interesting application of this, in my opinion, is in leading the growth of your business through these techniques. You know, one of my clients and I have been talking about, you know, never mind interpreting using natural language process to NLP to interpret a chat room and book a trade. Like, that's easy, and I think every firm is able to scrape a chat room and book a trade automatically. But what's much more interesting, perhaps, is what are the trades that we didn't get? And can the chat room help us understand that? Like, was there a price that we quoted, but we didn't get that deal? Why didn't we get that deal? Can we surface that out of the chat room, use NLP to apply some structure to what's going on there, and then perhaps inform our business about what we need to do better to get the next deal that comes our way? That kind of application of these digital techniques and technology, to me, is what's really going to drive the agenda going forward. Not just using it to reduce costs, but also using it to drive the business. And in order to do that, and this is sort of the core thesis that we're talking about at Capco right now, in order to do that, our clients have all the tools that they need, frankly. You've got every fancy fintech and every widget that's available to you that can really be applied in a compelling way. And what the leading organizations do really well is a word that we call orchestration. Pulling it together in such a way that your organization can get behind it and apply these digital toolkits in a way that makes an impact on your bottom line. That's really the core, I think, of what is differentiating between the leading organizations and the lagging organizations right now. You know, Max, perhaps we could start with you on this one. You know, do you see in your organization at UBS, do you see, you know, digital being applied in both those front office and back office techniques, as well as, you know, what do you see the biggest challenge as far as, you know, accomplishing that concept of orchestration?
I think you framed it very well, George, in terms of the, I guess, the opportunity. I think, as usually we say, you should never waste a good or a deep crisis, and I think that this is what I think the last 18 months really have really shown to us, right? Is how do you take advantage of disruptive conditions to accelerate some of these themes? I think to a certain extent, to your point, a lot of let's just call the more traditional automation techniques have been around for many years. Notwithstanding the fact that obviously we execute in millisecond and we trade in and we settle in 3 days up to 12 days, that is still behind, very much behind. But I think some of the techniques and strategies that you just went through in terms of for pricing or what trades are we not seeing or missing, I think all of those things are very much undergoing across many firms. To me, the key distinction now is, and I agree with your observation, that there is plenty of technologies and software and fintech. They offer off-the-shelf tools and techniques at a relatively cheap cost as well. There seem to be an abundance of those. I think the real challenge is some people frame it as new way of working. I like it to believe it as a new way of leading instead. To make all this complexity happen and really unleash the power of trades or clients that today you cannot serve in a non-digital way, so to speak. You have to have a very strong view as to the multidiscipline that you need to unlock those opportunities, and typically those disciplines sat in org charts which were fairly segmented over the years in our industry. So that's a challenge. The second challenge, of course, is not only the multidiscipline, but also the geographical distance. And in addition now as well, the flexible working arrangement, dynamic as well. And I think really that is a space where, creating the next set of leaders who can have the right level of knowledge on hard skills, i.e. some of the techniques that you just went through earlier without repeating, but also having the, if you like, the humanity, the brain and the heart, right, to bring it all together and to really pull various disciplines, geographies, different teams, different way of thinking through problems under unique goals. I think that sense of vision, strategy, and quite frankly, humanity as well, from a leadership point of view, is what I think will distinguish further and further a success, in my personal opinion.
Yeah, that's an excellent point, Max. I mean, Susie, perhaps we could zoom in on Max's point there about multidiscipline, and how that influences your talent strategy as well. We've been working with clients about what sorts of people are they going to be hiring to work with them in operations, and it's changing. It's absolutely changing across the industry.
Yeah, absolutely. I mean, we need to think about it less as operations and more about a digital business service, right? It's about, for us, it's about breaking those silos where before you might have planned a tech strategy in a particular asset class, thinking about the trading, the risk management capability, or a particular sales business that's all about the client, or then, the operations kind of is the afterthought, if you like. Then they'll just respond to what the business needs to drive. And we're really moving away from that. And we're absolutely starting with the client, with that client journey, the client interface, how we connect into the external, and then through those kind of life cycle trading, pricing, the operation services, but actually building it really front to back, with proper design authority, with funding that's held and managed very differently, so that you cannot execute in your silo. You won't get the money for it. The way in which we're budgeting, planning, thinking is very much end to end, from the client right up through the structure. And we speak about digital and data always in the same sentence, and it's so key because we got to get the architecture right. The data then has to come. We have to think about how does the data flow through that? What is the information that we need? And we have data strategies that aren't just around how we improve the quality of our data and remediate it, but also then the whole data as an asset, the point that you're making about how do we use that data. But for us, it's about making sure that data underpins those tech decisions, that the full journey for the client underpins that tech decision, that we don't allow decisions to be made as they may have been in the past. You know, and the skill set that we need is different, you know, and we talk about agile, and I think many people really misunderstand what it is as some sort of tech solution to everything, but it's a cultural shift. It's a change of mindset in how we operate, right? People need to think outside of their particular remit of responsibility. They need to think, it doesn't matter if they're wearing a trading hat or a risk hat or an ops hat. They've got to think about that end-to-end journey. They've got to think about the client and what we need to do. So we're using, you know, changes in the way we govern and manage and think about technology investment, technology spend, data, to bring it all closer together. And it's difficult. I mean, this is not easy. This is a fundamental change in how people have been working for a very long time. But it's absolutely key that we, you know, and it's not just about removing non-financial risk and operational losses and making us more efficient. You know, it is positioning us to scale, to give that sort of client journey, that proposition that we need to give. So the skill sets are different. We need people that think differently. We need different training, you know, both for the people we have today. We need to bring in a lot more digital focused training, and then we need to be hiring from you know, hiring based on skill sets, I guess, more than experience, which would be traditionally what we've done.
No, that's fascinating, and I think that's very relevant to many of our clients and many of the touch points that our capital markets team has in the industry. You know, we're touching on the talent, but also you mentioned over there the technical architecture that's involved in being able to work in this new environment and with this new mentality and with this new imperatives. You know, and I want to introduce Andreas Feil into the conversation, my colleague who leads our capital markets unit out in Europe. And you know, Andreas, you know, what is the, you know, can you elaborate a little bit on what you see the imperatives being related to the legacy architecture that banks deal with, and how to move that forward into the new world?
Yeah, thank you, George, and thank you, of course, to the panel. Yeah, I think the interesting part is that we now heard a lot about basically where you want to move to and then what the new world is. But of course, if you will look at what we see at most of our clients, if you bring up the picture of how the capital markets architecture usually looks like, you see probably 5 or 6 centered systems and around of 70 to 80 satellite systems and something around 300 interfaces. So it's pretty clear that to weave in the new thinking and the new world into what really the legacy is requires a lot of thinking, and it's actually what we see in the market is basically threefold, I would say. So there are certain players that really decide at one point of time that they are pretty much on a consolidation track. They say, like, okay, one of our core systems is actually the platform of consolidation, and that they use this lever to say, okay, all investments really in one direction, and then all the new world basically interconnected to that. While others say, like, okay, with the different technologies out there, orchestration layers, ways of using microservicing, we're getting probably all the flexibility in, and as well are able to introduce what the fintechs bring to the table much quicker to capital markets as well. And last but not least, a lot of consideration on what the cloud could bring to the table, not just as an infrastructure discussion, but rather really what can I do with the cloud differently than what I did with the traditional architecture, and how I could really leverage that. So the reality is that at all our clients, we basically see these two main strategies. So do I go central with a consolidation platform, or do I go more microservice orchestration? It's pretty much the two main trends we see, sometimes, of course, combined. But overall, I think the clear topic is that at the end, you need to get to something more streamlined. And like both of you mentioned before, as well, getting a little bit out of the island of capital markets, because in all fairness, capital markets and most our clients a bit separately from the enterprise. And we see that this is at least vanishing, and that it's closer. So maybe, Susie, I start with you. So what's your view on what do you see in your organization around this journey.
I mean, so the whole sort of collaboration and working together is a big part of us, and it goes back to those sort of growth, the strength in growth and focusing on the strength. So absolutely bringing together the pieces of the organization, not allowing ourselves to be standalone, restructuring ourselves so that incentives and partnerships become more natural, that we're not just all thinking about our own kind of piece of the puzzle. And you know, I think some of that is reorganization, some of that is incentive, some of that is common sense, right? It's bringing together the different capabilities that we have in a way that the sum of the parts is greater than, you know, than the individual points.
Mm-hmm. Yeah. Thank you very much, Susie. It's very interesting indeed. You could see still at some organization, at least, that we observe that's still a way to go to get this collaborative idea going.
Yeah, look, it's not easy when you're trying to change any kind of shift in the way that you operate, right? Whether that's through the way that the business is managed, through the way that we serve our clients, or through technology, it's hard to shift, it's hard to change. So it is about thinking about what is the easiest way to make that change? Is it through leadership and structure? So do I bring teams together with more of a sort of natural partnership? Do I incentivize people differently? Do I think about, you know, the way that we manage the business differently? Because yeah, change isn't easy, but it's absolutely necessary.
Mm-hmm.
I mean, it's an interesting point. If you it's hard to know if there's complete consensus around a non-legacy, let's say an innovative investment bank or an innovative global markets player that has maybe, I mean, Andreas, you talked about 300, 400 applications. Let's say it's possible to do it with 10 applications in the end, right? That's very smartly thought through. Could, you know, Susie, I guess, could you ever see a scenario where, much like Uber came in and kind of turned the taxi industry upside down, could you see kind of Nuco investment bank with massive investment in microservices, DLT, intelligent automation tools, and so on, and just leaps ahead of the competition and lands there? Because, you know, clearly I'm aware that many organizations in the industry are trying to get there.
I mean, I don't see anything that's new that would be as big as you know, the competitors. So because I think we're all suffering from the same thing, and the legacy architecture is an issue for us. So even if smaller players merge, they would have the same issue with them. And any brand new out of the box, I don't believe gets as big as the competitors. But I think we have changed the way we think about legacy technology, because, you know, years ago we would have always planned these big demise programs, right? We would have said, right, we're going to demise the program. It's going to the platform. The likelihood is the platform was not just a trading platform or a risk platform. It had accounting feeds, ops feeds, and many factors to it. So we're going to demise this platform. It will typically have more than one version of the same platform, you know, and you'd have these sort of 5-year multi tens of millions of dollar programs that you would run to demise, and they would typically fail, you know, or you would demise 75% of it and be left with the 25%. I think we've absolutely changed the way we think about that into sort of not necessarily thinking about starting with the retirement of the system, but starting with the, you know, reducing reliance on the platforms, you know, modularizing the pieces and you know, changing the reliance, but maybe saying, actually, but it's okay that still does my accounting, because that is maybe the most difficult thing to change, and actually does it very well. It's actually the risk part of it that I don't like, and I'll modularize that. So I think the way that we have to think about legacy architecture is different, and it's not all about the big demise programs. It's about taking the smaller pieces, modularizing, changing at sort of functional levels, and then making it easy for the systems to then connect in with each other. So you're reducing reliance on these very large legacy platforms, as we call them, but you're not always going at the big demise. And I find if we do small programs, you know, we're much more effective at running pieces of programs than we are these massive big multi-years. And the other thing that really sort of ties into this is the regulation, right? So one of our issues is we've always had so much of our investment really spent on responding to and solving for massive regulatory change, and we've sort of kept it over here. So sort of regulatory is over here, and then the investment for growth is over here. We're bringing them together now and saying, look, you can't spend all the money we're spending on FRTB or other things without coming out of it with an improved risk management environment. It's not just about responding to the regulation, it's about doing it in a smarter way, so the dollars you're spending are having more than one outcome. And I think that the sum of those two, rethinking the way you think about legacy and rethinking the way that you spend your money, so that you don't just solve for regulation, you solve for it in line with your strategy. I think the two of those together changes the way we think about it. But sort of bringing that back to your first question, I think all of the banks will improve on this, and at some point you may get a couple of them that come together and they're complementary in their journey. But I don't believe that you will have the new, bank as big as the likes of me and my competitors that starts with that shiny new kind of fintech tech.
Yeah, and I think Susie, so one topic you just mentioned is really something we as well pushing with our basically let's say application change programs as well. We called it something like Big Bang is over. So it's really something you want to get away. You really want to show after 3 or 6 months in your journey, you want to show results. So absolutely what we observe as well. So Max, how are your thoughts around this topic?
I think a lot of the observation that Susie and you, Andreas, as well went through are, resonate, very much with us as well. I would say that I go back to the kind of thoughtful differentiation point when it comes to legacy or removal of legacy. I think there is obviously a lot of trade-off between building new things with new technology versus unlocking complexity in legacy. I would say that a lot of the complexity that we have, for example, in onboarding processes, clearing processes, those I would say are a result of, I think, a very inefficient industry set of protocols. Whether it's the way that the data interacts across banks, whether it's digital identity or DLT, not yet in the right phase of maturity. And I think those things will take time. I think, to me, the flip side, I guess, of legacies, there's obviously a lot of areas, whether you look at content management, i.e. relationship between customer, research provision, sales and distribution provisions. That is a very interesting, I guess, space where legacy probably matters less, and there is a lot of unlocking that I think continues to occur. Think about the foundation for software as a service for risk management, pre-quantum computing as well, particularly for firms with higher degree of risk provisions as well. What does that do in that space as well? And then there is what I would say the areas where as an industry we are not as efficient as we can be, which is the reason, of course, why many clients outsource that operational complexity to their brokers. Where I do think that actually provision of industry services are probably the way to go to unlock more complexity originating from, let's just say, maybe more archaic pre-trade and post-trade environments that we continue to see. But I also agree with Susie's observation on how we do it. I think banks are getting a lot smarter. No more big bangs, and a lot more thoughtful actions to unlock legacy.
Yeah. I think thanks a lot, Max and Susie. And I think Owen, back to you. And I think we heard already from Susie the thinking around regulatory requirements and strategic investments. So we can share probably the Capco's view on that.
Yeah, no, thank you, Andreas. I mean, I was just musing actually about the kind of large program fail. I mean, I think we've all seen many examples of that, and often the program's changed name, which always is a very telling sign, right? But it's actually the same thing underneath. But I mean, just turning to regulation, and I touched on this at the start, and obviously Susie's just done the same thing. There is a significant amount of regulation out there that is designed, I guess, in the end, to make banks safer, more predictable, more transparent, and ultimately serve customers in a fairer way. That is the purpose, typically, of most of the things underway. And if you think about where a lot of that original thinking originated, it was 15 or so years ago in relation to the financial crisis, but things have obviously moved on since then. We have some newer things out there, such as ESG and how it links to data, and that is probably one of the most disruptive style events that will, and Susie, you spoke about budgets being, I guess, sucked up into regulatory affairs. I'm sure ESG is going to be one of those where it's going to be very, very expensive, actually, ultimately to comply. We also have crypto. Crypto, we've all seen in the press. Obviously, many people, I guess, in the audience on the panel may have dabbled in the marketplace, maybe being a bit sad at the moment, actually, on Bitcoin, given Elon Musk's activities and China's activities recently. But it's absolutely something coming, and the regulators will want very good control over it. So I guess my question is slightly different. You touched on the fact there's regulation, a lot of regulation still, and it is costing a lot of money. Some of it actually has unintended consequences. So just touch on that. CSDR, for example, the buy-in regime may lead to a lack of liquidity in certain products because there's shorting becomes much more risky. So I guess, how does the panel feel about the bank's ability now in 2021 to lobby more effectively with the regulators? Has the power imbalance shifted in the last 10 years, given the desires of many governments around the world actually for economies to grow post the pandemic, and therefore that sits really with the banks to facilitate that through enhanced capital markets activity, enhanced lending activity, and so on. So maybe the balance has shifted, but I'd be curious as to views with Susie and Max. Maybe I'll start with you, Susie, on that one.
Look, I think that the relationships have changed slightly. I think we built better and closer relationships with the policymakers, with the rule writers. The industry has done that. There are a number of industry forums where we can get together in the right way to comment or to have a view on pending regulation. And I think this is important. I think the regulators have a job to do. They, as you say, they have to ensure the sound operation of the market and fair outcomes to our clients, as do we, and that is absolutely our responsibility too. But the practitioners of those markets do understand how they work. They understand how they work under stress, and they understand some of these unintended consequences. So I think it's super important that we take the time to comment, to try and influence, to partner. And I think the door is open in a different way now to that than I think it was, many years ago. I still think that the way we approach it has to be in looking at things. It comes back to that, not looking at silo, not looking at one piece of regulation in one jurisdiction without thinking about what's already there. How is that market regulated? What does it mean? Are you regulating the product, the client type, the balance sheet type, the entity type? How does it all fit together? And making sure that we can improve the functioning and the order of our markets, but do it in the right way. So you're right, we don't have those unintended consequences. And I do think through the many different trade associations and industry bodies, we have a voice, and we need to spend the time and invest the time on trying to get the right outcome. So I think that's changed. Do I think we always get the right outcomes? No, but I think we are at least in a better position to help with the debate and help influence the outcomes.
No, very interesting. Thank you, Susie. I guess same question to you, Max.
It's a very interesting topic, and I think you could take the half glass full, half glass empty perspective on this particular topic. I think I would say the banks have got better at, I think to Susie's point just earlier, not to create a department that looks after regulation, implementation, and then everything else. I think from a technology architecture point of view, from a ability to spend the right dollars in the right applications to get to right compliance, ability to leverage RegTech solutions as well from the outside. I think all of those things have improved significantly over the years. I've always been the kind of half glass full person on this particular topic. I think that every regulation forces you to, or should force you to, take a very good look at your business model. So you could argue CSD, you mentioned CSDR on shorting. You could look at it that way. You can say, well, I can actually use RegTech and Reg dollars to decrease my number of fails by 70%. And not only that, but not only in Europe, but also maybe in the US or maybe more emerging markets like Asia. And how do you bring those practices that you develop maybe in Europe into the other location? FRTB, I think as well, there's a bunch of very, very interesting and deep topics on FRTB as well that they're really at the core of the regulation, but also at the core of how the business is run in that part of the business. So I think it is a combination to me of fully embracing these 4 opportunities to make changes to your business where is required, and do it in such a way that you don't do in a tactical way, you do in a sustainable way. You leverage internal and external resources, and you end up in a situation where you are more reg compliance, more scalable. And quite frankly, again, it goes back to the differentiation point. Could you use reg compliance as well as a way to differentiate yourself with your client base and with your regulators? I think that I think is another angle to this.
Yeah. I mean, it makes absolute sense. And I mean, I'm sure none of us on this panel, even in the audience, believe that the power of the regulatory bodies and the, I guess, dreaming up of new regulation will stop anytime soon. So the ability to, live in that world and use any dollars spent to improve the customer proposition, the efficiency of the bank, and so on is obviously smart. At the same time, delivering compliance. We're almost out of time, actually. We haven't yet discussed the location topic. I guess, Andreas, you just wanted to quickly touch on that, and maybe we'll get the panel's view from Susie and Max on how they're now thinking about location. That'll be useful. And then just a word to everybody in the audience. We are going to have a hard stop at 2:30, but UK time. But we do have a chance for me to pose some questions to the panel. So if you want to flood some of those in, by all means. But let's do two minutes, Andreas, say on location strategy.
Yeah. So
probably needs 20 hours, but there you go.
Yeah. Okay. Thanks for giving me the challenge. That's the way we like it at capital markets. So on location is indeed, I think the intro Owen clearly said that it seemed to be pretty much set. But certainly, I think the pandemic gave some influence to that on what the right location strategy is. But I would even like, after what we have discussed today, would rather take the topic of skills and collaboration, which is probably even more important, and just would like to get your view on how this influences your location strategy. And then maybe starting with Susie, we need to be quick.
Sure. Look, so we'll have a hybrid approach. It'll be very activities based and very based on what is happening in the different geographies that we work in. But collaboration and being sure that we're still supporting our individuals, that we have the right balance will be key. But if you think of the breadth of the types of roles we have, there will be roles that will be much more on-prem, and there'll be roles that will have a lot more flexibility. I think the interesting thing with this is how it changes our BCP more than anything. We have introduced a new way to, a new contingency method. So I think that's maybe one area to focus on, how it changes the need for large separate BCP offices, rather than the huge change it will have on our actual footprint and location strategy. But yeah, we'll be activities based and hybrid.
Mm-hmm. Yeah, thank you. Back to you, Max. A quick one from your side.
Likewise, look, this is probably one of the highest strategic consideration at the moment, right? In terms of not only acquisition of new skills, but also the flexible working arrangement and employee preferences. Obviously, there is supervision and cost management as well coming too. And in general, in a context of war for talent, so to speak, being able to attract the right skills wherever they are as a principle, of course, is another imperative. And I think obviously the technologies are making this a lot easier than in the past. And so this become an engineering problem to solve, right? Because you go from labor arbitrage to the point that Howard made earlier into a 6 or 7 layers engineering problem to solve, and clearly a lot of stakeholders and opinions in making the right choice. So highly strategic, highly relevant for us, and clearly a kind of a fit for future set of considerations.
Okay.
Brilliant. It'll be, again, much like regulation, location strategy will be a topic for many years to come. No doubt, almost infinite in terms of its ability to discuss and change and what organisations will do. So we've got 3 minutes left. I think I do have a couple of questions. So I'll just check the monitor, as it were. We have one here. Maybe George, I think I'll ask you to pick this one up. Question to Capco: what are the chances of disruptive technologies which are potentially beyond regulation or beyond the ability of, I think the question says, beyond the ability to be regulated, e.g. crypto, there will be a challenge to existing large banks which are slow to get or to recognise this?
That's an interesting question, because I think I don't know if I fully agree with the presumption that something like crypto is beyond regulation. I think that until those emerging technologies can create sort of a parallel economy, which is, in my opinion, a very long way off, where you can actually buy goods and services on a regular basis without converting to the currency of that region. I think that's without converting to fiat currency, as the digital asset folks like to refer to it. I think that as long as you want a dollar or a pound or a euro in your hand, there is a choke point right there for regulation to occur, and that's going to be an issue for as long as I can see. I certainly can imagine a future beyond that where you'll pay for a bagel with Bitcoin. But I think we're a very, very long way off from that. And until you don't want to transact with the local currency anymore, the regulation can and will come into play. What we're seeing is banks who want to get on and provide the digital asset capability to their clients, both from an asset management perspective, from a core banking perspective, from having a Bitcoin in your checking account concept. Those banks are doing it in a way that's very regulatory forward. They're trying to be on their front foot with regulation, because they don't want to get caught off guard with some emerging pinch that's going to come down on them globally.
Thank you, George. So there's one more question. I'll put this to both Susie and Max, and I'll make it a very simple way for them to answer so we can meet the time schedule. So someone's asked a question around thoughts about cost takeout through selling captives, basically. So I think, again, most of us have been around long enough to have seen the phase of sell and then re-establish, I guess, or let me call it buy. So I guess, Susie, your view on captives, sell or buy for the next 2 years?
Buy.
Buy. Max?
So then I understand the question well. When we say captive, what exactly do we?
So I think the question is related to a large processing center in India specifically, okay. And whether that's vendor sourced, i.e. you've sold it and a vendor provides a service, or whether you actually create your own and then have it as a UBS facility, so as it were.
My answer would be, it depends on whether that core capabilities over time become an industry core. If you become an industry core, you probably get to an answer. If it becomes a bank core, you probably get to a different answer. And I think the location strategy that you just described earlier, I think that's another input to those decisions as well.
Sure. Okay, we are out of time. I wanted to very much thank our panel, particularly those from obviously UBS and HSBC. So Max and Susie, we very much appreciate you being part of this panel with Capco today. And thank you for everyone in the audience for attending, and hopefully we made it interesting for you.
Thank you.
Thank you.
Thanks everybody.
Yep.
Thank you, everybody.
Yep. Thank you.